We have two presentations lined up for you. First, we'll focus on the corporate outlook for India, which will be presented by Hetal Gandhi, Director, MINA. This will be followed by a presentation on the role that the financial sector has to play to support this growth. This presentation will be delivered by Subhashri Narayanan, Crisil Ratings Director. So now I welcome Hetal Gandhi on the stage.
Thank you, Srinath. So I would request everyone to settle down. I'm getting a little nervous, especially after that exciting discussion that happened. So I would request that everyone should not make me more nervous about it. Yeah, thanks. So let's start with the presentation on India Outlook. I think the best part of the last discussion was that in a way there was consensus on growth rates. So having known the economic outlook, it's important and inevitable that we now dive what it means in terms of corporate India. So in the next few slides, I'll be taking you through what it means in terms of growth outlook across sectors for corporate India. We have divided the presentation into three distinct parts. First, which focuses on recovery curves, consumption trends, and therefore the revenue outlook. Second, that focuses on outlook on profitability, EBITDA margins, as well as balance sheet health. And third one, the golden question, are corporates going to be investing? So let me start with the first part, which speaks about India Inc. I think this analysis and this slide most of you would have seen. And that is because Crisil has been running this for almost 7 years, looking at 748 companies spread across 40 sectors. We look at corporates, non-oil, non-BFSI, and marry trends to understand what it looks like entering into the next year. We have always been saying that India's revenue growth mirrors GDP growth, more so nominal GDP growth than real GDP growth. And that's exactly what's coming out in this graph as well. FY24, we are expecting that a double-digit growth in revenues will continue, close to a 10% growth, very closer to the nominal GDP growth that is expected, around 10.5. What it also tells you is the stupendous growth in FY22 and 23 was higher than the nominal GDP growth, which means larger corporates got a better benefit of the price hikes that they did amid the commodity super cycle. So we clearly believe that this year the growth is going to be more evened out, more driven by volumes. More on this later. But another important fact that needs to be looked at is what's happening to interest rates, especially at the retail level. If you look at FY12 to 18, we did see a high interest rate scenario. Now, from a low of around 7.69 at a retail level, we are clearly going to 9.2. But still, after 2 years of strong volume growth rate, we don't see that really dampening improvement in volumes. I'll touch upon that as we move ahead. It is important to understand that India's revenues are a summation of many parts. So we divide these 748 companies into 7 key verticals. I'll take you through how those verticals behaved at the time of the recovery curves and therefore what it means for India Inc. Now, if you look at these verticals, just these 7 verticals account for 92% of the 748 companies' revenues. FY22, whatever revenue growth rate we saw, was not really evenly distributed amongst each of the verticals. Recovery curves were being more skewed by sectors like consumer staples, commodities, and exports. Commodities, of course, on higher prices, and exports because of a better rupee and services growth that we saw. Now, as we move into FY24, the clear verdict is that you will see an evened out recovery across each of these verticals. Please know, FY23 already saw the service verticals recovering. There are 3 key verticals which will drive growth in FY24. One, commercial linked verticals, which is power sector, which has been seeing unprecedented demand, almost a 10% volume growth itself in FY23, and now even price increases. 2, you have consumer discretionary services that lagged in the recovery curve, and you are now seeing airlines as well as sectors like hotels, which are seeing a very rapid recovery. And 3, construction, thanks to the government spends. So 3 laggard sectors which are now catching up. Many a times when we see this vertical level numbers, what we miss out is how much did volume recovery actually support this. In fact, Dr. Chenoy spoke about that in his part of the discussion. So let me take that a few ahead. We did a deep dive, dipstick for 10 key consumption verticals. We looked at both B2B and B2C verticals. So if you look at the chart and the top 10 verticals that account for 30% of revenues of the same 748 companies, you find that in FY21, the blue bars were all negative, a lot of reds, because volumes were declining amid the pandemic. But construction and commodity-linked verticals, as well as agri-linked commodities, really did not see a drop, which means that demand, in a way, is inelastic when it comes to downturns as well. Services were also equally hit. When we went to FY22, most of them moved in the positive zone. But you can clearly see the grays are outpacing the blue, which means that price increases were driving a larger percentage of the growth. In fact, only 2%, or rather only 25% of the incremental revenues were driven by volumes, and rest was driven by value. FY23 and 24 is seeing only the deepening of the blue, which means volumes are now clearly contributing more to the revenues. In fact, 6 out of the 4 sectors and almost 75% of the revenue growth, incremental revenue growth, was contributed by volumes in FY23, and that number is expected to go to 94 to 95% in FY24. But does that mean that we are doing really well in terms of volumes? For that, we put the last multiplier. And you can clearly see of the 10 sectors that we have put out, 4 of them that are in orange are just about reaching their 2019 volumes. The 5 that you are seeing in green are 1.3 times of the 2019 volumes, which means a minuscule CAGR of 5 to 6%. And two-wheelers, in fact, continues to remain below their pre-COVID volumes, almost 20% lower than what was happening in the past. So this clearly tells you that while at value terms you are seeing everybody being above the recovery curve, in terms of volumes, trends continue to be varied. Now, having looked at this, a number of other parameters have been evaluated by us, like urban incomes, premiumization products selling more, export markets specifically, where we believe we may end up doing better and not be as impacted as previous downturns, and some structural risk around that. More of that can be viewed in the report. But let me move to the next part, which is profitability. If you look at margins, there is a very strong story that is emerging. Margins are expected to recover 150 bips. But is that what I want to focus upon? Not really. Let's look at absolute profits. If you look at EBITDA profits, you are expected to reach around 11 trillion by the time you close FY24. Well, that means you are doubling your profits from FY18 levels. If you look at the past similar period, profits increased by only 55%. That speaks volumes about why India Inc. is on such a strong footing. Further, whatever drop in margins you saw in FY23, a large percentage of that was contributed by the commodities sector. Commodity companies saw almost 1,000 bips drop in margins. The increase in margins is going to be equally split between commodity and non-commodity sectors. So quality of profits is another positive that we are seeing in FY24. Now, with this kind of a background in terms of profits, it is important to understand finally what does it mean to balance sheet health. So we went second level deeper. I think the left chart, many of you would have seen as a part of the presentations that we have done with you. But what stands out is even audited numbers speak the same story. Long-term debt has dropped by almost 10% when you look at audited numbers of the same 748 companies. Short-term debt dropped sharply in FY21 as working capital cycles shrinked. It also increased in FY22, but please note, it did not go to the pre-pandemic levels. That, along with sufficient cash balances, has resulted into net debt to EBITDA going to 1.6 times. If you glance through the report, we have done the same assessment across sectors. And for the 30 sectors where we did this assessment, more than 20 of them actually saw a sharp correction in net debt to EBITDA levels as compared to the FY19 levels. So that clearly tells us that India Inc. is well placed. That is also corroborated by data of all rating agencies summed up by us. And you clearly see that the blue bars stand tall, which means your upgrades outweigh the downgrades. And both by debt and by count of companies, we continue to remain above the 1 ratio. Now, this background then really makes it enticing. And I have been reading a lot of reports that speak about private capex cycle over here. So let's move on to the golden question. Are investments for real? And I think this is one of the most debated areas. Coincidentally, industrial investments are a smaller share of the total investments that happen, but they have the maximum amount of interest because in a way that signifies private sentiment. So let me delve first into industrial investments and then I'll move on the infra side of it. Now, industrial investments clearly are showing an uptick, but the uptick is for reasons not coming from legacy assets. If you look at my left-hand side chart, average capital expenditure, which is being done by 20 key sectors, culmination of the same 748 companies shows that average capex would be now 5.7 lakh crores between FY23 to 27 as against 3.7 lakh crores. That's a whooping average increase of 2 lakh crores. Almost 50% of this incrementality is coming from just PLI and new age sectors that you see in the yellow and the orange bars. Then what is happening to legacy assets? The report has charts that speaks about how utilization levels across all legacy assets have gone up substantially. But we are seeing a story where there are specific players who are continuing to invest and not all of them. That is because they are still yet to pass their peak utilization levels before pre-pandemic. So there is still some room for improvement. Now, when we club the overall capex, we find oil and gas, metals, and cement combined together account for 40% of the capital expenditure, cumulative capex that is expected to happen. If I add PLI and new age sectors, that is another 17%, which clearly tells me that 60% of the capex is driven by 5 key verticals. There are specific players like auto who are continuing to stay on the fence. Because they want uncertainty in the environment to slow down. The CEA, as well as the economic discussion, spoke about this uncertainty prevailing. Now with that, let's therefore move a little deeper into PLI as it has been important for our country. If you look at the PLI timeline, we have spoken enough about how much investment is happening, but what is important is that nearly 60% of the capex is expected to transpire between FY24 and 26. If I look at these sectors, 3 sectors, auto, ACC battery and specialty steel, account for almost 60% of the capex. If I look at incentives, the story is a little different. My peaking of incentive payouts happens only in FY27. This says the complexity of the scheme has resulted into some amount of delays. But spread of incentives is a little less moderate. Mobiles, auto, and solar PV account for less than 50% of the incentive payouts. Having seen this, a lot has been spoken about vulnerability of incentive payouts. We therefore did a quick math. And what we found is that 56% of the incentive payouts are linked to very stringent payout criteria. So on the horizontal axis, we have put incentive realization criteria, and on the vertical, incentive to capex ratio. So sectors like mobile telecom are high on incentive to capex ratio, and they have less stringent criteria. Please note, those are the sectors where payments are taking place right now. If you look at the right, solar PV, for instance, has more than 5 to 6 criteria to be met for incentive payouts. Incentive payouts, therefore, will remain a monitorable to match the success of the scheme. So I think I've spoken about industrial, and we know the trends emerging over there. We are clear that infra is leading the pack. We have already seen central government push in substantially with almost 30% increase in capex, and therefore what it means in terms of achieving the targets that the government had set up for themselves. Key verticals in capex, if I put 5-year boundaries, it clearly tells you that roads, railways, and power are the ones that are going to drive infra investments as we move to 2027. Please note, with this kind of spends, we would be seeing almost 75% of the original NIP targets that were being set in. Please also note that with power sector and roads continuing to lead the pack, you will see investments of private players in the infra segment going up to as high as 25%. A few tidbits around green investments is also covered as a part of the report. But with that, the key question remains, how are we going to fund all the infra investments that we are talking about? While Gurpreet will discuss that during the panel discussion, let me invite Subhashri, who will take you through the credit outlook. Thank you.
Yeah, great. So thanks, Hetal, and good afternoon, everyone. So over the next 10 minutes or so, I'll just pick up from what Deepti had shared as our outlook on economic growth, and also what Hetal just covered on corporate India, and talk about what that means from a credit growth perspective, and also really the other side of the coin, which is how the financial sector is positioned in terms of its own fundamentals to support economic growth. And I'll start with some of our key takeaways from the presentation. We expect overall system credit to cross rupees 210 lakh crore, with all constituents contributing to the growth. So if you look at banks, their health has improved across key metrics, and they should grow at about 15%. Private NBFCs, they're now touching double-digit growth, and they contribute to the consumption side of the story. Government-owned NBFCs continue to play an important role in infra financing, which is a key focus area for the overall economy. Now I'll cover some of these aspects in greater detail. And to set the context, what we have here is a snapshot of the overall system credit, and it's growing at a steady pace. On the bottom left, we've broken this up by type of entity. Banks continue to constitute the bulk of this, over 70%. Private NBFCs are at about 16%, while government-owned NBFCs are at about 7%. On the right, we split up the bank plus NBFC pie by segment. So here, corporate contributes almost half, while retail is about another third. So against this backdrop, I'll just cover what we are seeing as the outlook for banks, private NBFCs, and government-owned NBFCs, and how that really ties into our overall growth outlook. So starting with banks, as I mentioned, they constitute over 70% of the credit pie. And hence, they really play a key role in channeling credit across all segments, be it corporate, retail, MSME, or agri. And in this context, in terms of the bank's own fundamentals, what we have here is a snapshot of the key metrics of the banking sector at different points in time over a 20-year period. So the barometer at the top represents the overall health of the banking sector during various periods, be it red, amber, or green. And as we can see, the banking sector has really gone through its fair share of cycles. But today, we are in a situation where we're seeing NPAs on a downtrend, we're seeing a healthy PCR, we're seeing profitability moving up, capital buffers are comfortable, and therefore we believe that the barometer is firmly back in the green for the banking sector. And therefore, this enhances the ability of banks to support economic growth. So overall, in this context, we expect the banking sector to grow at about 15%. While in recent years, we've seen the share of retail go up for banks, corporate does still remain the largest segment, about 45%, and really banks are the first port of call here. So touching briefly on what we are seeing for the corporate segment, growth had picked up this year, driven primarily by the additional working capital requirements and the shift from the bond markets in the initial part of the year. Now for fiscal 24, Deepti did speak about a lower GDP growth of 6%, but she also highlighted that this is partly driven by what is happening on the global front. In fact, domestically, what we see is that growth is actually getting more broad-based across sectors, and this is also reflected in the lending pipeline of many of the banks. Now, tying this also up with what Hetal just mentioned in terms of industrial capex picking up pace, and also infra capex, where while public funding will be large, banks also do play a key role. We expect corporate credit to be well above what we've seen in the past. And we also expect the contours of this growth to be a little different in fiscal 24, with a higher proportion of term lending compared to fiscal 23. Now, what also allows banks to shift focus to growth are the benign asset quality trends. We could potentially see gross NPAs touching a decadal low of sub 4% by March 24. In fact, the last time that gross NPAs went just about sub 4 was March 2014. Now we believe this would be driven primarily by the continued reduction in NPAs in the corporate segment, as the health of corporate India has significantly improved. We've seen secular deleveraging over the past few fiscals, and in fact, the median gearing ratio of Crisil Ratings portfolio is expected to touch a decadal low of less than 0.5 times this fiscal. Now, in terms of the funding side for banks, there are two parts to this, capital and deposits, and we have capital on the top here. So with public sector banks having raised more than 2.5 lakh crore over the last 4 years, all of them now have a cushion of over 100 bips on their regulatory tier 1 requirement. Private banks have also raised over 1 lakh crore. They usually operate with a higher cushion, and therefore we see that most of them have a cushion of over 300 bips. So what we've shown on the top right here is our analysis with respect to the tier 1 capital requirement till fiscal 2027 in 3 scenarios. And I'll just touch upon the base case scenario, where what we've factored in is a 15% CAGR in credit growth, and a similar buffer that I just spoke about, which is about 100 bips for public sector banks and 300 bips for private banks. In this scenario, we believe that banks will need about 1 lakh crore of capital, which we believe should not be a challenge for banks to raise. The same holds true for our alternate case, where we factored in slightly higher credit growth as well. So overall, if we put everything together from our perspective, the key monitorable now really is the ability of deposit growth to keep pace and support overall credit growth. So as we can see in the chart below, for the last few months, credit growth at banks has been running ahead of deposit growth, and the surplus liquidity in the banking system is normalizing. And to support higher credit growth, banks have started raising deposit rates, initially fairly slowly, but the pace has really picked up since October. Banks are, of course, also exploring other avenues of fundraising, such as infrastructure bonds, but it will be important for the deposit engine to start firing faster, and this is something that we will continue to track. So now, having covered what we're seeing with the banking sector, I'll just move to what we're seeing for private NBFCs. Now, these entities are predominantly focused on retail lending, especially in segments that may be difficult for banks to address, and therefore they play an important role in driving the consumption side of the story. So here, we've given the trend in the AUM of private NBFCs. Given the challenges that have been there, they did see decadal low growths of 2 to 4% in fiscals 20 and 21. But since the second half of fiscal 22, the sector has been steadily coming back on the growth path, and we believe that now private NBFCs are well placed to grow in double digits. And fundamentally, what supports this growth is the fact that over the last 2 or 3 years, balance sheets of non-banks have strengthened on many fronts. So firstly, NBFCs have raised over 70,000 crores of equity in the last 3.5 years, and many did this to really build a cushion for COVID-related challenges. So, and this can be really seen in the gross stage 3 provision numbers, and that's on the left. So we've seen a significant increase in the GS3 provisions for both NBFCs and HFCs since March 2020, and this number is now higher than 50%. Secondly, despite the fact that provisioning was high in the last few years, a combination of the large equity raise and the fact that growth has been fairly limited, that has led to a significant improvement in the gearing levels. And thirdly, we see that asset quality metrics have remained relatively resilient over the past 12 months, and really the concerns around the restructured book have also abated to a large extent. So overall asset quality outlook for most segments is now better. So while we talked about what supports growth, on the other side, NBFCs do need to manage the impact of the interest rate cycle and the competition from banks in many of their core segments. And for this, we see NBFCs realigning portfolio strategies for better risk-adjusted returns. For instance, unsecured loans we see have seen a sharp jump in disbursements, and growth is really expected to be the highest here at about 21 to 22%, really touching pre-COVID levels. Traditional segments of home loans and vehicle loans we believe will also see growth, but the growth rates will be lower than what we had seen pre-pandemic. Now with this, I'll just move to the third segment, which is government-owned NBFCs. And as we can see from their portfolio composition, their clear role is really to support infra growth. But before I get into some numbers on government-owned NBFCs, let's just look at the larger picture on overall infra financing. And this slide really gives a snapshot of the exposure of banks and NBFCs to the infra segment. So credit to this segment has been growing at a CAGR of about 11% over the past 4 years, and the pie stood at about 26 lakh crore as on March 22. Now the interesting point here to note is that within this pie, with banks having been relatively cautious in this segment, the share of non-banks has actually increased over time. And given like what we saw, which is that private NBFCs are almost entirely retail in their focus, it's really the government-owned NBFCs that have been contributing to this growth. In fact, as we can see in the chart below, in most segments, they have a sizable share. With that, what we have here is a snapshot of the government-owned NBFCs. And I'll just touch upon the bottom chart, which is on asset quality. We had seen an uptick in NPAs here, primarily in the power sector a few years back. But since then, even for government-owned NBFCs, NPAs have significantly reduced. Further, if you look at the provisioning coverage ratio, these have also increased about 67% from what was about 26% earlier. Gearing, we see, has also remained range-bound. So with all of this, government-owned NBFCs are well positioned to continue to play a key role in the infra financing segment. So that was it on the three segments that I had wanted to cover, which is basically banks, private NBFCs, and government-owned NBFCs. But before I conclude, I'd just like to touch upon how we see the credit landscape evolving, driven both by external factors such as funding access and also policy decisions. And I'll just highlight a couple of aspects here. One, we do see partnerships as an ongoing theme. It's beneficial for both banks and NBFCs. On the wholesale side, alternate platforms such as REITs, InvITs, etc., they're gaining prominence. And this really expands the avenues that are available for wholesale financing. And finally, we could see newer and specialized solutions coming in to tackle strategic initiatives. For instance, we've seen the setting up of a new AIFI for infra financing, and this really carries both a financing and a developmental agenda. Next, we could see, for instance, I think one of the options that's being discussed is really a green bank to address what are the needs of the sustainable energy, and so on and so forth. So if you really look at it, the point that I'm trying to make is that all of these developments and measures are really aimed at expanding the overall credit landscape, which in turn will support the India growth story. And on that note, I come to the end of my presentation. Thank you very much, and back to you, Srinath.
Thank you, Hetal and Subhashri, for your presentations. It was interesting to note how the financial profile of the corporates is improving, and they are well poised for the CAPEX cycle. For this, I'm sure we would like to hear more from our industry leaders on how the lenders and the industry captains are looking at it. With this, I would like to move on to our next panel, which will be moderated by Mr. Gurpreet Chatwal, Managing Director, Crisil Ratings. I take immense honor in inviting our panelists for today in alphabetical order of their last name. Rajiv Anand, Deputy Managing Director, Axis Bank. Suresh Goel, Managing Director and CEO, NHAI Envit. Dilip Oman, EVP, ArcelorMittal and CEO, AMNS India. Rajkiran Rai, Managing Director, NABFED. A very warm welcome to all the panelists. Over to you.
Okay, thanks. Good afternoon, everybody. And I know that we are the last panel discussion between all of you and lunch. So I think we'll try to keep in time. And thank you, fellow panelists. It's an honor to have you here. I think we have people with very rich experience in the Indian corporate sector, and looking forward to a discussion in the sense that we will be able to cover some of the themes we talked since morning in terms of how India is going to be poised in the next 4 years. So I won't spend too much time in the initial comments. So let me just start with Mr. Oman. I think steel is a sector which evokes very strong feelings with everybody. I think one of the factors we're talking about here is the infrastructure growth, which means that also the outlook, how do you see the steel demand, both India and globally? And also the other aspect is that steel also is a component which goes into most of the other manufacturers. So I think when the prices go up, it does impact margins. So wanted your perspective, both how do you see Indian demand and the global demand, and as well as, and I understand it's very difficult to predict prices, but obviously you have raw materials coming in. So just wanted your broader sense, how do you see the commodity prices or steel prices over the next few years?
Thank you. If you look at last year, the global consumption has come down by 2.3%, while the production came down by 4.2%, which means that there has been a reduction in the stock. And right now, what is happening is there is a restocking that is going on. I expect the global steel demand to remain flat or maybe marginally increase to a level of about 1%. Fortunately, China has opened up a bit post their change of COVID policy and certain stimulus that has been injected in the system. I see steel prices in China also firming up. If you look at the steel export prices from China, it's gone up by a substantial, what was at about 540 is about close to 670 now, dollars per ton. So globally, muted demand growth. China, because of pollution constraints, will probably see the production this year not going up beyond last year, maybe a little bit of reduction, but rest of the world should see an improvement. Europe that saw a reduction, especially in view of the geopolitical situation. The energy prices have become much better in Europe, and therefore there is an uptick in the production and consumption in Europe. America continues to do well in the steel sector. As far as India is concerned, India has been doing quite well in the last 2 years. In fact, close to double-digit growth. If you look at the last decade in the steel sector, the growth was close to about 4%. But this decade, I would expect the growth to improve to 7%. Last decade was service sector led. This year will be manufacturing industry led growth that will raise it to 7%. The second half of last year, the growth in fact was 11%. And this year I would expect about 8 to 9%. As far as the prices, you asked about prices as well. I mean, that's always, it's always in the media. Unfortunately, people only look at the steel prices. They don't look at the input prices. If you look at the input prices, iron ore prices have gone up by 50% since November of last year, including NMDC, which is a government organization. Even there, if you compare with November, now the price is about 50% higher. Orissa sector, the iron ore has gone up by 50%. Coking coal, it had gone up by 50% with respect to November, December. It's come down a tad to about 45, 46%. So input prices are going up, and therefore there will be a cost push, and therefore you have seen that the steel prices have also started moving up, but it's a cost push. And across this year, I would expect the steel prices not to remain at 60 or 61,000, but it will firm up a bit more. Maybe a reasonable estimate would be closer to $800.
No, thank you. I think that kind of will keep a little bit of pressure on the inflation. No, thank you. I move to you, Rajiv. I think the other aspect we've been, and I've been answering this question for the last 5 years, so I will caveat it in terms of when will the private sector capex start. So since you run one of the largest banks in the country, so that question I thought maybe it's fair to ask you in terms of how are you seeing the demand from corporates in terms of for their capex. We've seen prolonged period of muted demand on that. But I think as we saw in the presentations, I think we are also quite bullish. I think people are touching the capacity utilizations. But the point is when will the rubber hit the road? So any estimation on that would be helpful.
It is such a volatile environment, so I must use the Keynesian caveat that if the data changes, I will change my view. But having said that, I think it is probably the best private capex cycle that we have seen in the last 5 years. It is quite widespread, renewables, infrastructure, iron and steel, cement. We've also had one conversation, not conversation, we've actually lent to a FMCG converter. And so therefore the point I'm making is it is quite widespread in that sense. Is it, sort of the animal spirits kind of environment that we saw perhaps between 2003 and 2005? We're certainly nowhere there. But I think as the previous presentation spoke about as well, I think capacity utilizations are now at 75%, notwithstanding what's happening globally. I think we should see a continuation of this capex cycle. Corporate balance sheets are in great shape. There is a greater thrust on manufacturing in this country, and so therefore to that extent, I do see more and more corporates taking advantage of that. But I think one of the things that we're also seeing is an element of skepticism from corporate India in using leverage. You saw the numbers, 1.6 times, debt EBITDA, 0.6, 0.7 times equity, are, at least in the last 10 to 15 years, are probably the lowest that we've seen.
That's right.
And we are increasingly seeing whether greenfield, brownfield, the amount of equity that is coming in from their own internal accruals, etc., has certainly increased. And so therefore, the point I'm trying to make is we are, especially given, the capacity utilizations that we are seeing at this point in time, we are quite sanguine in terms of the private capex continuing into 24, 25, 25, 26, and so on and so forth. But I think we will have to, wait and watch of how much of that will come to banks. Yes, in the current environment, we are seeing, rates have gone up, so therefore the bond markets are to some degree frozen. We are seeing, global markets have their own problems. So I think, we will always be the first port of call, but we are certainly the point. I just want to leave the point here that there is an element of skepticism in corporate India of using leverage, which as a lender, I think it's great. I mean, if you're an equity investor, you probably have a problem with that, but as a lender, I'm quite pleased with that.
So just a linked point, I think while you said it was spread and it isn't animal spirits, it's picking up. Do you see any focus, or is it in the sense that are there certain sectors, are the PLI sectors which, while the government is trying to incentivize certain sectors in the country, are you seeing any of that being more widespread than the others? And the other, which is everybody talks about, is the China plus one, the supply chains moving in.
I think all of that is certainly playing out, and it is moot in terms of whether
whether this is the new manufacturing cycle for India. I mean, I think we'll have to, wait and watch. And whether I think the other play that could potentially play out over the next, 5 to 10 years is whether we will become an export hub in place of China. But I think there's a lot of work that we need to do in terms of our own infrastructure, regulations, customs, etc. For that to happen. I think the gap between us and China in that context is very large. Two is the ecosystem that's gotten built out in China is large, vibrant, and very efficient. And for us to be able to replace that, anytime soon is going to be, quite difficult. But I think if we broadly believe that the underlying economy will grow somewhere between 6 to 8%, I think domestic demand itself will be quite strong. And so therefore, to that extent, manufacturing in India, should be quite strong as we go forward. Yes, we're seeing, a lot of activity around PLI and stuff like that. But if you look at it on the other side, M&M has a 1-year wait period for most of its cars, and they're doubling capacity as well. Just to the same point, M&M has a truckload of money of cash on balance sheet. I don't think they'll come to us to borrow.
That's right. Okay. No, thank you very much. I think what it does give a sense that there is capex happening. It is just a question of what they're using. So, Mr. Rai, before I come to you as your role as in NABFID and the way the NABFID is going to, I just wanted to get your views on, because you've been a banker all your life, so just wanted your perspective on if you'd like to have, give a sense that how are you seeing private sector capex, or in terms of you're hearing around that, or the way PLI is moving capex in?
Yeah, when it comes to private capex, maybe I'll restrict my thoughts to infra related, because it is a lot to do with the manufacturing sector also. Maybe the solar is something which will be connected to us. When it comes to solar, actually, I think your chart also showed the kind of restrictions placed to get that incentive, which is highly restrictive. So how it will play out, we don't know. So, but then it is very much required. But when it comes to private capex in infra, as of now, it is about 18 to 19%. You see a lot of infra happening all around us, whether it is road, on energy, and many things actually happening around. Only less than 1/5 of that is private capex. So that means more than 80% comes from public spending.
That's right.
I think that is the very reason why NABFID is created, basically over a period of time. We are not able to get the private capex in a big way into the infra sector for whatever reasons we had. We had seen our cycles, we had seen the creation of NPAs, then again corrections, and the related policy changes around this also we have seen, including resolutions. Now the road sector, the transport work, has highly evolved today. The financing models also have evolved very well. I think this is doing very well today. And on the renewable side also, we have seen, I think that is one of the sectors where a lot of capex, private capex has come in. I think some of the data points show that it is more than $70 billion which have come in the last 7 years. Out of that, more than 15 billion dollars in the last 1 year. So that means this has attracted investment. Both on the brownfield side and to some extent on the greenfield side also. This is one sector which is able to attract some investment. Can we replicate this in other sectors will depend on the kind of policy changes we do and the kind of ecosystem we build. So, but then, see, there are another data point. To reach 75% of our NIP plan, we need 22 lakh crores of investment every year.
Every year, yes.
So, till 25. If that has to be done, we have seen in the budget 10 lakh crores and another 3+ lakh crores from the state side and all that. But where is that other gap coming from? It has to come from the private capex and those initiatives. So building that ecosystem to attract private capex actually is very important. We have lessons in front of us, learned that how this private capex can be attracted. I think we need policy changes. We need a better ecosystem. We need better dispute resolutions. We need better project assessment skills. There are many things. A better bond market. All these things have to be played out. Like, NABFID is created that all these areas are addressed. It is a, if you look at the Act, all the enablements there are there in the Act, because the experience over last 2-3 decades, I think, have gone into this so that we can play our role in creating this ecosystem that private capex comes in.
No, thank you very much, sir. So I just wanted to carry on the same theme from a NABFID's role in enabling infra development in the country in the sense and supporting it through infra financing. So how do you see the role of NABFID, say, for example, over the next 1 year and then over the next 5 years? Is there a different strategy you would like to follow from a growth and enablement of the infra growth, or any sectors you are looking at which you believe will pick up over a period of time and you would need to support them?
Actually, we have two roles, definitely clear, distinct roles. One is financing and another is on the developmental side. So actually, we have quickly adopted to the financing side because the country needs more financing in this sector. So actually, if you see the announcement from the government side also, that when they gave capital of 20,000 crores, by the way, I think we are well capitalized, maybe to take care of maybe 3-4 lakh crores of book in the next 3 to 4 years. So that is the aim. We quickly try to reach that volume in this sector by next 3 to 4 years. So financing role is very clearly given. Right now we are focusing on what is available, because creating a pipeline for financing takes time. That is a part of my developmental role. But right now we are trying to help the infrastructure sector space in financing. So one of the distinct advantage we have is the kind of asset liability profile we have compared to the commercial banks which come into infra lending, is we can do 30-year loans.
That's right.
And today the insurance and pension sector in the country is also highly evolved with a lot of money available, the patient's capital. Right. Actually, definitely we need to raise this kind of money so that we can invest in infra, which NABFID will play a role. And on the developmental side, we need to facilitate the infra players also to tap this money. It is not only NABFID raising money, which we can easily do being a sovereign entity, but then we should also help the corporate sector, particularly in this space, to raise this money by way of long-term bonds. Because particularly the infra, which is 20 to 30 years kind of time frame, it can't be financed by a 1 year kind of liabilities. It has to be necessarily financed by this kind of long-term funds. So on the developmental role side, actually, we are looking at deepening the bond market. Credit enhancement is an essential part of that. Okay. Because most of these infra on completion, they are BBB or A rated. That's right. So they can't hit the bond market. So credit enhancement as a product is very important. 7 years back, 2015, actually RBI has come out with some guidelines on credit enhancement, but they are a bit restrictive, particularly when it comes to the product, because even though purpose of the regulator is to cover the risk well, but then it has become a bit cost prohibitive by way of the product. We need to work on that so that the capital requirement comes down and the cost comes down, and as a product it takes off. It is not that we have not seen this product. We had seen 2-3 instances where this product has come in, but then it has not picked up because of the cost issues. So I think if you work on that and if the credit enhancement as a product picks up, I think the bond market will also develop, because many of these corporates, from the loan market, they can move to the bond market. Actually, that is one thing. And the secondary market also has to be developed. So we are planning that we should facilitate all this, so that, infra financing and the private capex, when you talk, unless you build all these enablers, actually the infra finance and the private capex side will not happen.
No, thank you, Mr. Rai. I think this is something at Crisil Ratings we've been talking about, the structure or credit enhancer bond to be able to hit the bond market and be suitable to many of the investors' risk profile. But I think we've done some work on this. But your steer, sir, I think will be very, very positive for the bond market development. Thank you.
Thank you. Actually, Crisil is doing a lot of work with us on this area. We are able to prepare certain concept papers on credit enhancement, including municipal bonds.
That's right. No, thank you, sir. Coming to you, Suresh, I think this is more in line with the broader. I think we've seen some excellent work on the road segment or the road sector in the country. I think the kind of development we're doing or the roads we're making per kilometer now, I think we haven't seen for a long period of time. I think that's also helping. I mean, from a long-term perspective, it does help quite a bit from an economic growth. So just wanted a quick perspective. I think when we put out the National Investment Pipeline a few years back, I think it had a pretty long rope. And roads have been the sector which actually been the front leader there. Just wanted your understanding in terms of, that's one aspect. And the second is, it also talked about asset monetization and monetization in a manner that you could actually fund the growth back. In both these, while roads have been probably the front leader, they are still behind the targets what the NFI set up. So just wanted your perspective, how this journey has been, and any suggestions you have, how we could further enhance this, both the build-up as well as the monetization.
See, first of all, I think I would say that it's great to be on a platform and forum in which infrastructure is being talked about. Just go back a few years ago, and I'm sure a lot of people sitting in this room would agree with me that the last sector that you wanted to be in was in infrastructure sector. And I thought that at my grand old age of 50, my career is going to finish right on a sunset sector. So I think compliments to the government and all of us and some of the stakeholders sitting around me, including Crisil, in which we are having very robust conversations about infrastructure in general. We have put some ambitious targets both on the NIP and the NMP. What it does, and something that, again, experience teaches you, and also my experience of moving from this side of the world to the other side of the world, is that change takes time, right? But it doesn't mean that it stops us from being ambitious or putting some guardrails through which the various ministries, stakeholders, companies, developers then have some targets for them to meet. I do agree that we have had some mixed successes, both on the NIP and the NMP. But if you look at the chart that was presented just before this session, that at 75% achievement of NIP itself, I would say would be an achievement. If you were to compare ourselves with vis-a-vis percentage target achieved of the various plans that we normally come out as a country. So it's not a bad outcome from that perspective, number one. Number two, and I kind of will come back to your question, but just picking on what Rajiv was talking about, is that we have seen infrastructure growth, but it came on very, very shaky and flaky foundations, right? Both in terms of the capital structuring, risk allocations, quality of the people who were involved in those discussions. And as a nation, as institutions, I think we paid a very heavy price for that. We don't need to go far, just go back just about 2015, 2016, 2017, right? Including the road sector was in a pretty bad shape. Come to a situation now, whenever we are now talking about infrastructure, whether it's on the investment side or on the monetization side, we are talking about more realistic expectations, right? Both from the investors, bankers, stakeholders, and including the government, which gives me the confidence that there may be slowness in our progress, but the foundational underpinning behind this whole thing is quite strong. Apologies for the long answer, but just on the last point that you just mentioned about the NMP itself. See, the fact is something like NMP requires just not the monetization, but there are a lot of foundational works that need to happen before an asset can be monetized. The second part of that is, where does that asset sit? Roads has been a success because, one, the asset sits on the balance sheet of the government. That means whatever monetizes goes to either the Consolidated Fund of India or to NHAI, which quickly can be put back into redevelopment. But when you look at the sectors such as gas pipelines, oil storages, transmission lines, or power plants, etc., they're all sitting within listed companies, right? And to an extent, then what happens is that the decision making is just not about the monetization, but also with regard to how that company's balance sheet is, what it can do with that capital that comes back to them, how they're going to deploy that capital. And again, going back to Rajiv's point, a lot of these companies are actually cash rich. They're under leveraged, right? Maybe negative debt on their balance sheet. So there has been some reluctance from those companies, and credit to the government that they have not pushed those guys to say that, go ahead and give me special dividends and all that kind of stuff. So some level of decision making has been left at that. I think that the second part of that on the NMP, and there's a lot of work happening there, and I'm part of that committee, is that what is the concessional framework that should underpin the asset or the asset class that gets monetized. So on 2 or 3 sectors, we have very good examples where there are robust concession frameworks, roads, renewables, power, transmission, etc. But when it comes to gas pipelines, railways, locos, other ancillary infrastructure, etc., there is no concession framework either available, or if it's there, it's not something that you can have bankable or investors coming in. And there's a lot of work happening there. So I think I'll close this answer with saying that, one, we seem to be on the right path. We seem to be taking all the right steps. The foundational aspects of what could make infrastructure growth a success are all there. We will make incremental progress, and just we need to be patient. Thank you.
Thank you. Now, I think that's fine. Thank you. I mean, I'll come back to some of the points you raised. Maybe let me just go to another round. But I think the very interesting aspects you've raised. But I'm sure I'll come back to you. So let me go back to Mr. Oman. I think steel, I mean, all what we talked about is a very large infrastructure build-up, and steel is an important component. And what we've seen from what we cover as Crisil Group, we believe that over the next 5 years, some 35 to 40 million ton of steel capacity is being planned across India. And it could be larger, but at this point in time, this is what we see. And India, as you said, last 2 years has been strong growth, and with all this build-up, it's unlikely it's going to slow down. I'm sure as an organization, you would have actually deep dived into see where these demands are going to come from. While we have seen cycles where we've actually done a large amount of investment, and then we actually export a lot of steel. So just wanted your perspective, would we be able to absorb all the expansion we are doing? Or, I mean, also in your perspective, what kind of industries do you think are really, demand is picking up at this point in time?
So you rightly said 35 to 40 million tons over the next 4-5 years. And even if I assume that 6-7% steel growth, growth in terms of consumption, it should lap up all that steel. But the point is that when steel growth takes place, it's not in terms of 1 million, 2 million. It's in terms of 5 million, 6 million coming all of a sudden. And, you need some amount of exports to cushion that, and over a period of time that picks up. So that is why exports are required. Let us say a plant comes up with 6 million ton project coming on stream, which means that if you want to put suddenly all the 6 million in the domestic market, may not happen. Maybe half of that, 40% of that. Rest has to be exported. But as far as Indian steel consumption is concerned, fortunately or unfortunately, the per capita steel consumption is so low in India. It's at best in the region of 77, 78 kg. So that can only improve. That's the good part. And as you have seen in the budget, there's a 33% increase in the capex spend. I think about 10 lakh crores. Then this is apart from what is going to come from the states. So there is a lot of focus on infrastructure, which is good news for the steel industry because it requires steel. And then it's a little bit of chicken and egg situation because you require infrastructure for the industry to grow. And in that process, the steel consumption also goes up. So whichever way you look at it, it's good for the steel industry. The auto industry is doing well, and there'll be a lot of steel demand coming in for the e-vehicles coming in, replacing gradually the petrol and diesel vehicles or hybrid vehicles. One of the areas that we see a growth is that there is a focus on decarbonization. And therefore, apart from investment in steel, there will be investment in renewable energy. The steel companies themselves focusing on renewable energy. See, how do you make green steel? It's renewable energy plus scrap, or renewable energy plus a lower emission level where you go for a different process like DRI. But then all this requires investment. Now, even if I assume 40 million tons increase, it's an investment of $30 billion that will go in directly into the steel. And this is apart from the renewable energy. So the summary is that I don't see a dearth of demand in India for the next 7-8 years at least, if not more. So we should see a healthy growth rate of in the steel sector of 7-8% at least.
Okay. Thank you very much, and that's heartening to see. I'm sure it'll be more than that. Now, my next question is Rajiv. I think there is few audience questions too. So let me just cover both these in one go, Rajiv, and I'll let you answer the way you'd like to answer. I think one is on the asset quality front, from a banking perspective. I think we've come to if our numbers, I think what we are projecting for the end of FY24, we would touch across the banks at part 4, with corporate actually coming down steeply. We've seen two trends. One, over the last few years, retail growth has been stronger than corporate, while corporate is picking up. So, and many of that funding is also because banks are funding NBFCs who are pump priming, or actually funding to the retail segment, and banks are picking up those portfolios. So your perspective in terms of how do you see over the next few years, retail, is it sustainable? Is there anything you're seeing which is concerning you in the retail growth? Usually when you have a strong build-up in credit, I think we have to observe over a period of time. The second question, or maybe let's complete this and we'll come.
I think on the retail side, if you look at penetration of credit in our country, still continues to be sort of relatively small as compared to peers. And if you notice that most banks still continue to be lenders only to the prime,
Okay.
which is CIBIL scores of 700 and above. I think there's a market which is certainly there below that, both in terms of the kind of customers that exist there, and also I think we need to go deeper and deeper into this country. And I think data and digital and technology is helping us do that. Our ability to reach deeper into the country thanks to technology has improved significantly. The presentation spoke about partnerships as well. I think partnerships is 10 years ago, banks did not think about partnerships the way that we do today. I think as we think about the last mile connect, our own Bharat Banking works with Airtel Payment Bank, India Post Bank, CSCs, etc. In a sense, like a hub and spoke model. 50% of our branches are in semi-urban, rural, but they work with these guys as well to increase penetration. Ultimately, one has to look at on the retail side to really worry about is household leverage. But I think in the Indian context, especially given the fact that a large part of retail books still continue to be to salaried employees, I think in general the formal sector has had it pretty good, barring a few sectors during COVID has had it pretty good. So the income effect has played out, despite the fact that interest rates have gone up and inflation has gone up. By the way, interest rates are now back only to pre-September 2019 kind of levels. So a mortgage used to be 8.5% in those days. It's back at 8.5%. So the COVID impact has got wiped out. We will have to wait and watch. I mean, I think if rates go up by another 100 basis points, I think the first flush of for example, on mortgage loans increasing, tenors, etc., has played out. But if rates go up by another 100 basis points, we'll have to wait and watch. One of the things that doesn't happen, while we are seeing much faster transmission because almost the entire repo book is, the entire retail book is repo linked.
Yeah, that's right.
When rates go down, EMIs come down. But the customer doesn't save that, saying, hey, maybe a year later rates will go up, so let me create a like a debenture redemption trust of reserve in his bank account.
That's right.
They spend that money. So by definition, when rates go up and EMIs go up, I mean, yes, you can do something with tenors, but EMIs are inevitably going to go up, and your salary or whatever it is hasn't gone up, or income hasn't gone up to that effect, and it could potentially have issues as we go forward. Still early days, but this is certainly that we need to wait and watch. The other sector which I think we haven't spoken enough about, which we are very bullish on, is this whole MSME sector. Let's say 5 crores to 1,000 crores. And I'm actually a bit surprised that the previous presentation didn't speak about the fact that that credit in the quality of credit in that book also has significantly improved over the last 5 years. And it is granular. The business is diversified across multiple sectors, across geographies, and so yes, the vulnerability exists, but because you keep diversifying the risk away, you're in a pretty good shape. Corporates, I think we will continue to lend to infra as well, but I mean across the way we think about the corporate banking business is ultimately we have to serve the customer across the capital structure. If he wants bank loans, we will take on, we will give him bank loans. If he wants bonds and debentures, we'll use our originate to distribute capabilities. If he wants equity, we will work with Access Capital and so on and so forth. How much of that exposure we want to hold on balance sheet? That is, I mean, that's a function of our own risk appetite on a project to project basis or company to company basis. So if you look at it across, I think we will continue to be, balance sheets in general will continue to be driven by the retail side. Banks like us have a more, balanced book. About 55% is retail. If you look at SME plus large corporate, it's another, the balance 45%. We're quite comfortable here. It's really about how we can optimize ROEs from here, which will determine, which way we go in terms of allocation of capital between retail and corporate.
Perfect. I'll come back to you. This is an audience question, but I'll come back in the end. Mr. Rai, over to you in the sense that while we've talked about infra, I think what also happens is that when we speak to banks or other institutions like insurance companies in private, I think the infra is a 4-letter word. I mean, the fact that banks have been around for long, they've seen those NPAs. So I think that whole thing comes back. How is this cycle different from the past? So your perspective in both sides is how do we see go forward in terms of NABFID's role, in terms of, you talked about the development role, but just your perspective as a banker, are we in a much safer position, and what would you say to your colleagues in the banking sector or the insurance companies that going forward, how does infra look like?
Yeah, things have really evolved. Like it is much better concession agreements now, and much better counterparties. In the road sector, because we have seen the cycle, because I was in commercial banking for more than 3 decades, I have seen the few cycles. I think we learned our lessons, and particularly on the road and renewable side, actually, if you see, much better concession agreements now. That's why actually now today the road projects, actually there is a competition to lend. If you see actually for the better companies and the good projects, there's a competition to lend. And our friend is here from NHI, he knows. Actually when he comes out with the invite, there is a plethora of sanctions, and actually he has to choose actually. That kind of sanctions are always in place actually. So that is the this thing. So it is basically because better counterparty like NHI, a better concession agreement, almost all clearances in place before the appointed date. So which actually it was the missing piece in the earlier regime, which resulted in delays, NPAs. Because in infra, what happens, any delay results in huge cost overruns. That's right. That's why the whole viability of the infrastructure, the revenue model goes to a toss. So I think now most of those things are fixed. Similarly, on the renewable side, we have a counterparty like SECI. And when you come to transmission, you have a counterparty like Power Grid. You know, that is what actually has changed actually in the last 4 or 5 years. That's why the banks are comfortable lending, the investors are ready to come in and invest, and that is what the changes we have seen. Can we spread this to other sectors is something we need to work on. Basically, see, whenever we invest in infra, the impact is on quality of life. That's right. Every infra investment ultimately results in improving quality of life for every citizen. Whether it is a metro with a better road, better energy, everything. Now, urban infra is a piece, actually, which is huge. As per World Bank reports, we need to invest $55 billion every year for the next 15 years to have that quality of urban infra. Because as the country is growing, are we improving our quality of life? It will depend on our urban infra investments. Now, nothing much has happened around this. Can we replicate these models around there, like better municipal bond issuances, better identification of projects, be it sewage treatment, drinking water, healthcare, education, urban mobility? Because next 2 decades, we will see another 10% of rural population moving into urban centers. That's right. And are we creating that urban infra? So this is something which policymakers are really working on, and maybe the better models have to evolve in financing this, because we already have cases where we are able to build systems. So from a financing perspective, earlier regime, what happened is we went and did it, learnt our lessons in a bad way by creating NPAs and losing money and all that. Now, this time around, can we build better financing models with all that experience so that we invest and we don't face those issues what we faced earlier? So that is the way forward for all of us.
Thank you, Mr. Rai. I think hopefully we're getting there. Suresh, coming back to you on this aspect itself. We've seen a good amount of private participation. I think you answered in some form, I'm elaborating this question. In some of the sectors where, as Mr. Rai said, concessions were fairer, we had enabling infrastructure. So we'd seen strong private sector participation in roads, I think renewables, airports, and many of them are amenable to monetization as well. So while you mentioned that there is work going on in other areas, trying to replicate concessions, all of that, just wanted to understand how do you see the priority of that working? And I'm asking you because you now moved on the other side of, previously you were part of the investing side and looking at the government and saying that they should make it fair. Now you're part of the other side, trying to, work to ensure that some of that is done quickly and your perspectives are shared so that some of that works. So just wanted your perspective. I'll leave it open-ended, whatever you want to share. So that's what.
See, first of all, I think there is a huge sense of urgency within the government as a headline around infrastructure development. And I think everybody is quite conscious of the fact that at this point in time, greenfield infrastructure development has to be heavy lifted by the government. I think there is no ambiguity in anybody's mind about that we are going to impose that upon anybody else except the government were to take the load. So that's point number one. Point number two is then comes down to balancing the books with regard to how are we going to raise the resources to fund whatever we are funding. And that's where I think the story becomes a bit more nuanced than just the headlines. And the fact that comes about is that sector to sector, if you look at it, and again I go back to the point that there are certain sectors where the balance sheets of the corporates which are leaders in their respective fields are actually quite cash rich, right? So from that perspective, just to say that we have to meet the monetization target for it to reignite the capex cycle, perhaps is a bit premature for us to comment on that. The area where the government can have a low-hanging fruit and is quite similar to NHAI is on the railway side. The assets are sitting on the Government of India's books. The decision-making is entirely with the Government of India, and that, i.e. the central government, which is again far more efficient when they have to take their own decisions vis-a-vis getting states involved into that. And the third part is that, as we saw in the slide also, it is it's the sector both in terms of the impact as well as the investments that is going into. And that is where a fair bit of effort is going in currently. Within that, I think on the monetization side, before we come to the monetization side, there is another aspect that is not get covered here, is the coordination between the various ministries in terms of getting the whole infrastructure pipeline through. So that's where this Gati Shakti that is spoken about. So there is now alignment of how the approvals take place within the various ministries, how the projects get aligned in terms of land acquisition, how a fiber can be laid alongside the highways or the railways, then it's being laid out, etc., etc. So overall optimization of capex is certainly happening there. On the monetization side, my sense is that railways is perhaps, they will come out with some model sometime during this year. It's quite clear. There is continued emphasis on the road sector. The targets for FY24 are going to be higher than what they have achieved in FY23. Apart from the InvIT, which I have had the fortune of leading and setting up and bring it to this level, but the TOT program, which kind of had dropped off the radar a little bit, which is the conventional privatization mode, is coming back. Now there is a TOT 11 and 12, which is currently under bidding as we speak. And the sizes of the TOT bundles are also increasing to attract larger players, right? So it's a journey, but I think what gives me hope is that we are moving in the right direction there.
Okay. No, thank you for sharing this. I think we're nearing the end of time, so I have a few audience questions, and maybe we can target these questions to a few of you, and the others can give closing comments. So I think one question which is talking about that corporate India is poised towards capex. I think the question is, and I'm sure it's a banker, what are the learnings for banks from the previous credit cycle which can use for the coming year so that we don't repeat the same thing? So over to you, Rajiv, on this.
So I think we've, the panel has pretty much answered that question. I think on the infra side, one, as Suresh mentioned, I think for the very large infra, I think it's very clear that the first phase of growth, the greenfield needs to, the heavy lifting needs to be done by the government. And I think thereafter the monetization in which, the one that, Suresh runs, we're seeing that, playing out, and that's a great vehicle where you're able to get in, global capital into that, and then that gives confidence to bankers to be able to participate in almost completed projects or, completed projects with long-term annuities. Second, I think, the legal and regulatory environment has significantly improved. If you look at renewables, for example, the only bankable projects are where the counterparty is NTPC or SECI, as the case may be. But the question to ask is, what about, how do we widen this funnel to bring in more state governments? I mean, today the confidence doesn't exist, and so therefore we will have to come up with new, structures to be able to give bankers the confidence to take on, state government risk as well. From a private capex perspective, I think as long as it is on existing balance sheets of corporates that we are already doing business with, we are quite comfortable with that. Most of the private capex, unlike the infrastructure, most of the private capex is anything between 18 months to 48 months. So therefore, to that extent, the tenor risk that you're carrying on this is relatively small. And of course, because we're also insisting on I mean, the aggressive 90-10s kind of structures, no longer exist. Like I mentioned to you, the corporate is also happy to bring in, equity up front, or maybe a large chunk of it up front and the rest over a period of time. But I think ultimately, these are sponsors or promoters that we're comfortable to do business with anyway.
Okay.
And so therefore, to that extent, I mean, if there is a new promoter who comes in with a greenfield or brownfield project, we may or may not, look at it. But for existing customers, our chosen set of customers is customers who are A- and better rated. For these customers, if they, in most cases, if they do come up with a brownfield, certainly in some cases greenfield as well, we would certainly look to work with them.
Got it. No, thank you.
I just like to supplement. Actually, when you look at infra and the related companies, totally new set of players evolved post 2017. Before that, we had a set of companies. Most of them went down for various reasons, but then a new set of companies have come up. Maybe there's a dozen companies which are really good, and they get most of the projects, and particularly the greenfield execution. As Raju rightly said, their capital cycle is 18 to 24 months. They execute, and then the brownfield, they put it to InvIT, or they sell it away and all that. Because there's a good demand for completed project because of the counterparty, like it is either annuity, it is ham or something like that. So the issue is actually looking at the infrastructure pipeline what we have. Do we really have the capacity that all these projects will be executed by this set of companies? Should we go down to the second tier companies which are there? But our experience with those companies are not that good. They are capital starved. Actually, when we look at the top, we get a feeling they are very good, they have cash reach and all that. But then their order books are already reaching 15 to 20,000 crores. Then how much more they can do, because now there are more projects coming up. So I think there is case where the second tier companies have to be capitalized, they have to evolve and reach that level. So we need to have more and more companies because the risk is spread. Otherwise, the top tier companies, actually, there are too much of risk sitting with them. So that is a challenge, because when people say the corporates are cash rich, we are looking at that top layer and talking. But then I think they are not enough.
No, that's right. Rajiv alluded to it. I think the 50 to 1,000, I think there's a strong growth there too. I think we are seeing some good players actually come up. So I think we're near the end of the panel. Suresh, would you want to offer any closing comments? Is the increasing interest rates a concern?
Actually, I think the way I would put it, not just on the interest rate side, but how we are seeing capital coming into the infrastructure space, because ultimately that's a fuel that drives everything, right? Gotcha. So I think we as a country are getting into a bit of a sweet spot in terms of global capital flows and the domestic savings now coming into this. The two sectors which hitherto were not really attracting capital, manufacturing and infrastructure, are beginning to be on the radar, on the conversation tables. A lot of strategic discussions happening around the credit committees, investment committees around this, etc. So that's a good thing. I think everybody does believe that, and I'm currently, let me paraphrase, caveat my comment to say that I'm speaking more of what I'm seeing as the international capital looking into India.
That's right.
I think there is a general acceptance that India has managed this extremely well. The risks are much more balanced.
That's right.
There is far more appetite for investments into other sectors beyond the conventional sectors that are coming through. One thing that I agree with Rajkiranji, that they do want strong sponsors. We as a country cannot afford to have smaller players and then flipping over again. As far as the interest rate is concerned, I think the risk premium is accordingly has increased, but given that we have a superior quality or more attractiveness with the vis-a-vis other markets, so that risk premium is actually kind of not increased commensurate to the interest rates.
Got it.
Right. So that will be my
Thank you.
remarks.
Mr. Oman, any last comments from you?
Not really. I think a lot of people I can see hungry faces. The climate change is one area which will catch a lot of attention in India and globally. Globally, it has already drawing a lot of attention. If you look at US, they have this Inflation Reduction Act, that reduces, that really incentivizes the production of hydrogen, etc. So this is certainly an area that will require a lot of attention in India. A lot of countries are waking up to this, but then this is for next session, next time when we gather together. Thank you.
No, thank you very much. I think it was an interesting session. So I won't attempt to summarize it. Thank you very much.
I would now request Gurpreet to honor our panelists with a memento. Thank you, Gurpreet and the panel for such a captivating session. With this, I would like to announce that we have concluded our second and the final panel discussion for the day. And I would like to invite Suresh Krishnamurthy, Senior Director, Crisil MINA, to give the closing remarks.
Good afternoon, everyone. When facts change, I change my mind. What do you do, sir? Rajiv paraphrased this quote during the panel discussion. Hopefully, the varied presentations on global and India outlook have presented facts and insights that help you form opinions that make the markets function better. On behalf of Crisil, I would like to extend my heartfelt gratitude to each and every one of you for attending the India Outlook event today. It is an absolute pleasure to host such a distinguished group of people who are passionate about the India growth story. I hope your time spent here listening to our speakers touch upon the macro and micro factors dominating the India economic scene was productive. I'm confident that you would all be returning with valuable insights and actionable ideas. I also want to thank our distinguished panel of economists, bankers, and industry captains for their participation, support, and enriching views. I'm looking forward to your feedback, and we will use it to improve our future seminars. We would like to stay connected with you through our social media handles, emails, and in person. I also want to thank my Crisil team for organizing this edition of India Outlook and hope to see you all in the next Crisil event. I now request all of you to join us for lunch in the adjoining hall and continue our conversations. Thank you.